So jobs numbers are coming out on Friday, and continuing on with what we talked about last week in the podcast on how I think the market is very sensitive right now to jobs numbers. And with the regime that we're in, we are still in a risk off regime. I think we are in an environment, as long as this is a strong risk off regime, we are in an environment where data is going to slowly get worse and worse. And it's that environment that breeds that decay. And I'm wondering if that's what we're going to see from the jobs numbers this week, if we're going to see another progression towards a deflationary confirmation. Is that what you're expecting?
Well, I think that the jobs report is obviously the first one for 2025, but we're not reading 2025 data yet, obviously, right? Because it's the first month and we're getting last month's data, but it's the first print, um, technically for 2025. And I think that the way that the labor print's set up right now, so the Fed central tendency max between 2024 and 2027, right? So in that range, we're in 2025 now. So 2025 to 2027 is about 4.5%. So what that basically means is we go much higher than 4.5%, things start getting a little bit wonky from the Fed's perspective. I think you see extreme resurgence of dovishness on the table. All this hawkish fluff gets kind of punched in the mouth. We've seen bond yields go pretty much up only since the last FOMC meeting, and then really up only since the Fed started cutting interest rates. We cut 100 basis points, and bond rates are up, right? So it's quite interesting how that works, but the reason for that is it's in the convoluted process of the Fed's component of forward guidance, right? So the way this works is the Fed was seen as being more less restrictive 2.5 months ago than they are right now. Now the Fed's seen as only bringing rates down to about 4% in 2024. So basically, one and a half rate cuts from here. Excuse me, in 2025, one and a half rate cuts for the year of 2025. That's pretty extreme given that the unemployment rate's at 4.2%, right? So if you look at the we're going to get NFP on Friday, but tomorrow being Thursday, we're recording this Wednesday night, the markets are closed to honor late President Carter. And in the process, the next trading day is going to be the NFP day on Friday. So the consensus range for that NFP print that we're going to see in the next couple of days is between 4.2 to 4.3, pretty much 4.2. So not much of a change, right? So for what we've seen, so 4.2 to 4.3, that's in the range that the high from July of last year to where we are right now. So basically 10 basis point wiggle room
Well,
here.
the funny thing is, too, is that central tendency of 4.5 was a revised one. Their previous report was a central tendency of 4.2 for the next few years. So what's going to stop them from just revising it again if we do hit
Well, I think
4.5 soon?
I think the way that this works is as we drift up, there's going to be less and less of a of a cause to claim for room to wiggle, right? Because you could say, okay, we just came off of a secularly tight labor market. We could just, we have to have some breathing room here before we start overreacting, right? But you move the goalpost long enough, and eventually things become unavoidable. I think that we're in 30 basis points, a 30 basis point range of the NFP printing, right? The non-farm payrolls, or I should say the unemployment rate, right? Because they're not the same thing. But the unemployment rate printing in that 30 basis point window there, that window is probably the cushion, I would say. Anything in that area, the level of dovishness in the market is not going to be extreme. you supersede 4.5%, I think you're going to get a wave of dovishness again. We're going to talk about 30-year coming back down, maybe even as much as 50 basis points as the Fed tries to put cuts back onto or at least tries to talk cuts back onto the table. The big factor here that we're not even mentioning at the moment, on top of all this, is the incoming administration, right? We have someone that is looking to cut taxes, put up increase tariffs, and basically there's underlying risk that the deficit is going to widen, right? The deficit as a percent of GDP. So you have this issue here where tariffs can negatively affect GDP, right? Tariff increases should bring in revenue, but the tax cuts should drop revenue as well for the government. So the government's going to have an issue where they're basically their outlays are less than their incomes, and they're going to be in a position where they're going to have a deficit. Now, the altercation of or the altering of the Fed the altering of the tariffs versus taxes is going to lead some people believe will lead to a wider deficit. And I don't know if that's necessarily true. I think that's you're really jumping the gun there. I think we kind of have to let it play out because at the end of the day, the deficit's a very touchy subject. I think you do need to bring the deficit down, right, in terms of what we're the excess that we're spending versus what we're taking in as a country. But you bring it down too much, and you actually run the risk of being too conservative, and you stunt economic growth, and
Yeah.
therefore you stunt the economy. So it's such a fine line, and we have an administration coming in that is making very bold statements, and they could be a play on the markets. He could be making Trump could be setting up the markets into a position where he talks real tough, beats the market up a little bit, gets everyone on edge, comes in, walks some of it back, and cruises on along. I don't know what he's going to do, but historically, Trump has not been dangerous for the deficit. So I think that we have to take that into consideration that he's not gonna. I don't think we're gonna have a risk of completely blowing out the deficit. I don't think that's really a risk at the moment.
Yeah. Well, going back to the yield curve and the yield curve being one of the best recession predictors, and now we're seeing it normalize, specifically the twos and the tens normalize and move much higher. However, typically what you see is the twos dropping as rate cuts get priced into the market. But now that's not what's happening. We're seeing the twos stay the same and the 10-year yield rising. And that's what's normalizing the curve at a higher level. What is that telling you?
Well, I think you're basically just seeing the bear steepener in action here, right? You're seeing the yield curve revert because the long end is rising, and the primary driver of the long end right now is, I mean, just look at the 2 year, right? So if you take a look at the 2 year, we're up significantly from September, right? We're up like 60 basis points on the 2 year, right? That alone is telling you that we sucked a lot of cuts out of the market here.
Yeah.
And on top of that, right, to lay this on top of, you had the deficit issue we spoke about just a few minutes ago with the new administration being, markets don't like uncertainty, right? So this new administration is bringing a lot of new tactics to the table that people aren't, it's not that people don't believe, and it's not that it can't work, but people just aren't accustomed to. Therefore, you're shaking up the markets, and the markets are going to get a little on edge. And as we've been seeing, it's been hard. The markets haven't been making all-time highs. Rates have been chugging higher. Dollar has been ripping. These are all signs that there's a signal in the market that the Fed is only part to blame for this entire move in rates. It's not all because of the Fed's stance of taking cuts out of the market. It's more than just that. And I think there's a political driver here too, being the financial tactics of the new administration that are going to come into play here in the next 30 days. We'll start to see them.
Yeah.
Maybe a month. I mean, January 20th, right? He's inaugurated, so you got to give it another month from now, and I think we'll start to see some sort of clarity in the direction of where the market has an idea of what's going to happen. And just take a step back, go back to, the 2018, 2019 trade war era, right? When Trump was just constantly pumping trade, constantly like pushing the trade war button, with China, and the markets were on a pendulum, right? They were
Yeah.
just swinging
Every
from the
month
ups to
there
the
was
down.
a trade war fear and the market
Yeah, I
dropped
know.
and then up, it's fine. And then another fear.
And I think we can't discredit that we can't just discount that. It's not like, oh, the market remembers that. They know what happened. It's going to be easier. I think it's in hindsight, a year and a half from now, 2 years from now, or when Trump's out of office, we'll be able to say, oh yeah, it was easy to see what was going to happen, and at the end it all settled out. But like, unfortunately, in real time, I think the markets are a bit too sensitive to just ignore, to just play the, um, we all know what's going to happen in the end card, right? So I think there's going to be a little bit of volatility. As some people like to say, Trump's MAGA hat should be make volatility great again, right? Because that's what Trump's a volatile person, and he's definitely good for the economy, and he's definitely good for the stock market, as we've seen, right? But I think in the process, you have to be accustomed with a regime of higher volatility with him in
Yeah.
the administration.
Well,
I think that's just
especially
how it has to be.
especially at the start, I think there's going to be some growing pains as there's all of that uncertainty. And I think that even puts a bullish case on the utilities trade. I'm very bullish utilities. I think that's really where money is going to flow to for the next few months. At least it makes sense to me with all of the unknowns, the uncertainties, and especially with the rate cuts being taken out of the market, growth still kind of being on edge. Utilities just seems like the better probability trade versus tech or even full blown risk off and going into bonds. I think
I mean, let's
utilities
just be
is like the
honest. Let's be
perfect
honest.
middle ground.
Let's be honest. Bonds look horrible.
Yeah, I wouldn't touch bonds with a 10-foot pole right now. This is terrible. As long as it's bearish
No,
trend, do not touch bonds.
yeah, no. I mean, listen, this could be the holy grail bottom here. NFP sends bonds up, TLT up to $90, and we're like, oh yeah, that was the bottom. But like in reality, most of the people remember us sitting here and just telling everyone this is what bonds can do. Now, I'm not saying they're going to do that from here, but bonds and bearish trends are uninvestable. Like they just get chopped to death. It's annoying, especially with leverage. It's like it'll kill you. Like we until they're bullish trend and we're in the right regime, bonds are a no go for us. But I do want to say, like, even just taking a look at the 30-year, right, the long end of the curve, at some point this is going to have an impact on risk assets, in my opinion. I don't think you can ramp the 30-year up to 5 from 4 to 5 and then higher without having consequences in risk assets. I just don't think like that makes sense, because at the end of the day, right, we have to look at it from a perspective of real yields, ex inflation. Like you're getting, if we scroll out, like in terms of where we are right now, you're getting some of the high, not, this is only going back to 2010, but in the last, I'd say 15 years, this is some of the highest real yields that you're going to find right now at in today's current yield on the 30-year, because inflation is down compared to where we were in 2022, and bond yields are up significantly, and therefore the real yield's higher. Inflation swaps or tips aren't pricing in the same inflation rate versus bond yields, so bond yields disproportionately higher, therefore real yields are higher. And I do think that there's some cause to some blame here to say that there's a shift in the neutral rate, right? Like the neutral rate of interest is higher, therefore real yields need to be higher because the the baseline in the economy of interest rates is higher, being the neutral rate. That's a bit of a conversation we don't need to have right now. I just think that that is a bit pushing it, because you're playing this game here where, if we take a look at rates, right, you're playing a game where you're arguing that the neutral rate is something that is set and doesn't change until it changes, right? Like the idea that the neutral rate has moved up from 2 to maybe 3%, whatever you want to call it. The However you want to calculate that in terms of real, non-real, however that component is on your side, the idea is that the neutral rate has moved up. Now, in my opinion, the way I look at the neutral rate is it's dynamic. It's not static. It's not a number that the Fed can look at once every 3 months and say, oh, neutral rate up. That this neutral rate's shifting dynamically with the economy. So I think that in reality, what we're seeing is a neutral rate that shifted higher in the last 12, 18 months. And I do think the neutral rate's probably at or near a peak where, we had these crazy prints in GDP, right? Where everyone was like, oh, how are we having these real GDP prints of like just in July, right? What was GDP now? 5.4%, right?
Yeah,
Of
I think
23.
like growth was just so
Sorry.
strong, and even our system was telling us that growth is strong.
Sorry,
And
sorry. This was 2023. I want to clarify. We were in the twos, I believe. Here we were sitting in about 2 to 3%. But continue.
but yeah, even that's stronger growth than anybody expected, and just having that level of growth is going to bring up expectations for the neutral rate to be higher. And now the system is picking up a shift in growth, and we're not in that same growth environment. And I do agree with you. I think the neutral rate has peaked. I think it's already peaked. I think we're on the way down already. And this is where you run into the issue where the Fed holds rates too high for too long.
Yeah, and I think that's a that's the problematic scenario. That's the most problematic scenario at the moment, right? Because the last GDP print was 2.8, right? So this is the last official figure for September. GDP now, right, as of the recording, is at 2.6. So if we look at this on just a simple, right, 2.8 to 2.6, we're looking at a quarter of disinflating growth. As easiest way I could put that, slowing but growing growth, right? Now at 2.6, it's not problematic. I don't think 2.6 is that big of, that's good, but that's not obviously far from recessionary. I think the issue here is if we get into an environment where we're seeing sub 2.25 prints, right? That automatically becomes an environment that was not the last 2 years outside of this 2022 blip here. Like from the end of 2022 on, we've pretty much been printing, I'd say, above 2.1% consistently. Maybe there was one print below 1.8 at the end, at the beginning of the year, but we quickly snapped back. All in all, we're over 2%. I think you get under 2.25 back down to 2%, and possibly in the ones. You're gonna run into a situation where everyone's like, oh well, maybe, just maybe, the neutral rate isn't as high as everyone thinks it is. And at that point, you kind of feed this loop. I guess the best way to to simplify would be like a feedback loop, right? Where as you fall in growth, everyone's anchored expectations of neutral rates only then falls, right? The neutral rate stayed like can we see longer run here? Let's see. Here's what the neutral rate looked like. Okay. So this is the longer run Fed funds rate. Now this is not the real rate of interest. This is the rate at which the Fed has to set, right, their policy at. So understand this is where the Fed sees their longer run policy at. It's not the same as a neutral rate, but it does the job in the projections, right? So we were at basically 2.5% up until the first quarter of 2024. So, and then we popped up to 3, right? So like now if I overlay GDP on this chart, right? Maybe this will make some more sense here. Oh, let's see if we can hide these drawings, make it clean here. Okay. So GDP, we have this COVID suppression, right? Where COVID hits, GDP gets whacked, the Fed drops the neutral rate from around 2.8 to 3 down to 2.5, right? And think of this as a path and not so much whole numbers. The whole numbers are important, but they're not relevant for the discussion right now. The Fed locks rates in at 2.5 on the neutral rate, okay? And or their projection rate, and they hold this here. Now, growth rips, falls, and trends higher for the most part here. It's much higher. We're at or above the pre-COVID levels. Okay. And only recently does the Fed start lift in the last 12 months does the Fed start lifting the longer run projection rate. Okay. And this has to do with, well, number one, the Fed hiking rates in 2022. They started the hiking process, but it was only until 2024 where they start rapidly bringing up the neutral rate, or their
Yeah,
longer term
and bringing it
fund
up
rate,
to pre-COVID levels.
pre-COVID levels, right? And growth, if we take a look at what growth is doing, right, and we go back to the growth, let's take a look at here. Collapse this out. Growth is at now pre-pandemic levels. So this idea that the neutral rate is significantly higher is not the case, right? Because then now we just looked at the Fed's um, long-term funds rate at 3%, right? So it's back to where we were pre-COVID. Growth is pretty much where we were at pre-COVID at this point, right? We're back to this 2018, 2019 realm. Obviously before the drop off here. But you look at something like
But you got
the
real
10-year,
yields, which are way tighter.
yeah. And you look at something like the 10-year, which is significantly tighter than where we were in 2018, right? So you have to ask yourself, okay, well, if all these factors are coming to play, there's an underlying risk here that the neutral rate, or the risk at which the Fed is in balance, is actually coming down now, but the Fed is still thinking there's some upward pressure to go. And I think that's where the unemployment rate prints are going to be like the shock. This is what shocks people. This is what always shocks everyone into light, right? All it takes is a couple solid up prints here. Like, I'm not talking about like 10 basis point moves. Like we kind of saw it happen in July. Now, it was an overstatement, obviously, but we saw a rip 20 basis points and everyone was really on their butt, right? Like, they got knocked on their ass on a 20 basis point move there. Now, I mean, if we can get a 20 basis point move here on Friday, I'm not saying that's going to happen, but I think that any type of upward pressure from here into the 4.5s is going to bring some dovishness on the table. Now, the contrary to this is that the Fed is at a point where they're restrictive, but they're actually more neutral than we all think that they are. So again, meaning that they're meeting that neutral rate on the dot. They are in a policy position where they lower rates, but like they're not too low, they're not too high. Economy's chugging along, and they're going into better balance. And that's a possibility. I'm not going to discredit that, but I think the base case here is likely the Fed is in a position where the neutral rate, they're not forward looking, they're backwards looking, and the neutral rate definitely lifted, right? So I think that it comes down to the natural rate of interest, I think, has peaked, and I think the Fed is still backwards looking, and they're looking at the rise. And in that process, they're still scared. And I think there's going to be a gap here where unemployment will continue its trend higher. And in the process, I think bonds eventually peak out. I don't know if it's going to be here or if it's going to be a little bit higher than here, but I think rates peak out, and in turn, they roll over. They come back more to an acceptable range, and in the process, I think risk assets initially see some life. All assets. If I had to break this down into like a segment, the 30 years at 5% pretty much, or just close to where we're 8 basis points shy. The first 50 basis points down from here is going to be an everything rally or everything positive. Doesn't matter if it's crypto, stocks, bonds, defensives, everything gets some life into it. And then it's once you get below 4.5 that things start getting a little shaky again. I think that's pretty much where we are in the dynamics of what's going on here. Does the 30-year need to go to 5.1 first? It's 5.2. Yeah, but I think that the first initial move on rates lower is going to be an everything booster, and then after that, it's going to be somewhat up to where the regime takes it. But I think that's where we can wrap up this week's podcast. If you guys have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.